Hi, I'm Marin Katusa. I'm here with Rick Rule, who I personally believe is the smartest and hardest working person in our business. Rick, I modeled my whole business after you, and I think you've gone from a mentor to now a personal friend and partner in our funds. I think the viewers would want to know, where is Rick Rule's mindset today at the beginning of January 2015, where, for the last couple of years, we've been in an awful downtrend. You've stated that, it's got to get better. We're not there yet. Where are you today?
Well, my mantra has always been to be where other people aren't. And in resources, that's becoming increasingly easy because people are abandoning the sector in droves. I see a lot of opportunity for people who are both patient and disciplined, but I don't see very many patient, disciplined people.
Patient is what time frame is patient? I was patient for 10 days at the hospital and I couldn't wait to get out.
Of course, but that was serious. In good times, I have found that the type of investments that I have made that have really aided my reputation have required 4 or 5 or 6 years to really, truly mature. Most of the people that you and I compete with, Marin, in speculative resource markets believe in the tooth fairy. They believe that they're going to get a 10-bagger in 3 months or something like that. My experience has been that making money in junior resource companies involves answering unanswered question, but truly a series of unanswered questions, 2 or 3 of them. Each yes answer raises another question. And so my experience has been that the quest for a 20-bagger or a 30-bagger involves 3 or 4 key determinants. The first is, of course, the series of unanswered questions and a lot of patience. The second is a starting point in either a bad market or a bad place or a bad commodity. That is very little competition on the way in. And the third is a very good person. And you have a sort of circumstances right now where most people don't like any commodities. Most people don't like any places. And the outlook for the sector is very bad. I'm not certain which of the speculative endeavors I'm backing today are going to work. But I know for a certainty that given the amount of money that you have to invest to get a place at the table these days, that this will probably be the most productive period that I have ever participated in personally.
So let's talk about how you're participating, Rick. I've learned a lot from you on structuring the financings to how to play them. How are you allocating your money? I don't see Rick Rule buying in the open market, being the bid for the sells. How are you buying?
I would prefer, in every case, to answer unanswered questions by providing the capital in a private placement. The reason is that if you are providing catalytic capital to answer an unanswered question, getting the warrant, getting the ability to enjoy the benefit of a yes answer, which are rare, twice, is what has made my style of investing work for me. The truth is, Marin, as you know, if you are speculating, the probability of a yes answer in any particular question that you ask is fairly small. You make more bad decisions than you make good decisions, and the consequence of that is that your good decisions have to amortize your bad decisions and leave room left over for an acceptable margin, which requires a warrant. As you have noted to me in prior private conversations, the issuers have been extremely sticky with regards to price expectation. The reason that we haven't seen more financings in Vancouver and more financings involving natural resources has been, although there is a reasonable sum of willing capital, the expectation of the issuers doesn't seem to take into account the market conditions that we're experiencing. There's a gap, a classic gap between the bid and the ask. And I've been affected by that too. We have a very, very, very large amount of unallocated capital, which I'm mostly unwilling to put into the general securities market because I understand the need for capital in the private market.
So is there a minimum threshold before, Sprott has $7 billion assets under management? At what point does Rick Rule stop speculating in these juniors that did bring him the 20, 30 baggers, or are you still investing in the right management with the right structure, but what I call micro caps in private placements?
Well, certainly Sprott was built in the sub 500 million market cap space. And one of the things that we're trying to do today is in fact participate in the sub 5 million market cap space. We like to be where the competition isn't. The difficulty is, as I say, the price expectations of the management teams are such that we've been precluded from being in that space, even though among institutional investors we seem to be the only one willing to inhabit it. I'm not sure what the reason for that is. Maybe there are high net worth individuals who are competing with us. I don't know the reason why we haven't been able to allocate more capital in a market where the industry suggests that it's screaming for it.
So when you're a contrarian, what is your most focused or desired commodity that you think is most out of favor today?
Boy, that's a tough question. That's a really tough question. The one where bad pricing has gone on for the longest is probably uranium. But I see extremely soft demand for energy worldwide, so I don't feel any particular need to rush into uranium.
So are you doing more debt in the uranium sector, or are you doing equity right now?
We aren't able to allocate capital in uranium. As I say, the price expectations on both sides of the ledger are such that we can't do it. And the demand for debt in the uranium side, given the fairly small number of issuers, has precluded our participation. I would suggest that in terms of the debt part of our business, the bridge and mezzanine business, that clearly where we're going to be in 2015 is the energy sector. There will be mezzanine opportunities, just like there were mezzanine opportunities when the oil price fell in the early part of the decade of the 90s, like there was in the mid-80s. The opportunity will revolve around putting in place a mezzanine slice when a company's revolving credit facility gets termed, and getting an intercreditor agreement with a bank and saving a good issuer by giving them enough liquidity to ride out the bad times. That's how I learned the lending business. The opportunities to do that occur once every 10 years, and we're coming right into a probably two-year-long period where there's a $2 or $3 billion need in Calgary.
So in this debt, you're more focusing on this Western Canadian Sedimentary Basin. Can they even work at $40 oil with your mezzanine debt exposure?
Sure. There are large parts of the Western Canadian Sedimentary Basin that can't work at $40 oil or $50 oil. The shallow Eastern Alberta gas at this price just doesn't work. The liquids-rich Montney, Duvernay, if they have reasonable access to transmission infrastructure, $40 US is difficult. $50, $55 US works pretty well. The ability to sell condensate, if nothing else, as a diluent to the heavy oil means that the better parts of the Western Canadian Sedimentary Basin works at these prices. And as you've noted in your own letter, Marin, one of the things that's been interesting in the Western Canadian Sedimentary Basin is that the E&P business, the exploration and production business, doesn't have to be E anymore. It's just P. And when you take the center of those liquids-rich fairways and you are able to drill off proved undeveloped reserves with ready access to gathering and processing, if you have exit capacity to get the dry gas out after you've stripped the drip, while the business is nowhere near as robust as it was for $90 oil, there's plenty of room left over for a well-structured credit facility, particularly where you have stranded capital.
But at what point do these PUDs become, the proven undeveloped, become completely worthless? At what point do we write down these two Ps? Because a lot of them...
Outside of the fairways, a month ago.
Yeah.
Outside.
So I don't think the markets have yet come to the realization, especially in the U.S. where they have much more leverage than in Canada, that a lot of these two Ps, that to me is a promoter's, soapbox.
Clearly true, Marin. And from a lender's point of view, you have to be very discerning, first of all, about the operators that you finance, and secondly, about their existing capital structure. When I say intercreditor agreement, I mean that as a mezz lender, you have to negotiate with the senior creditor so that they don't have to provision for the loan.
So mercifully,
at Sprott, we've done this for 25 years.
So you'll only do first secured?
No, we'll happily do mezz, but we get an intercreditor agreement where they can't sweep for 5 years.
Gotcha.
These are really structured products. And the other point you make is worth discussing for this audience. That is that we won't begin to have a sense of the carnage until the third quarter of 2015. That's true for at least two reasons, probably three. You need to see the impact not in press releases, but rather on the income statement of $50 and $60 oil. The second thing is that you are going to need to see, after the annual reports come out, what the net present value of the proved developed producing reserves on these companies' balance sheets are. In other words, how the engineering firms revise net present values and how that impacts the company's borrowing base under the senior facility. But the third thing that people are missing is there is an enormous delta between the published price decks of the major engineering firms who do these engineering reports and the price that the market is establishing by way of the forward strip. We're seeing in Calgary the consensus among engineering firms and banks for a 3-year out oil price at $90. And we're seeing in the futures market, in the strip, a 3-year out forward price of $70. There's a $20 delta between people's opinions and opinions that are expressed with a check. I've seen this 4 times before in my career. In every case, it's reconciled, and in every case, it's reconciled towards the strip, not to the estimate. So I think really people who wanted to get into the equity slice in the sub $2 billion market cap space had better wait till at least the third quarter of 2015 for these 3 issues to reconcile themselves.
Couldn't agree more. But let's get now into the price of oil. Where does Rick Rule, with 40 years of experience, let's start with the WTI, let's say in the next 12, 18 months?
That's really a function of demand. People are pointing out to all kinds of factors in the oil market as to why the oil price declined. I know you have your own opinion. From my viewpoint, none of the alleged manipulations could have occurred if we had strong demand for oil. But the truth is that the recovery that so many people talk about, particularly the US recovery, would appear to be a very strange recovery, and if it's a recovery at all, an anemic one. Yes, you've had jobs growth, but you've had no increase in labor force participation. You haven't seen real workers' incomes rise, except ironically in the oil and gas business, and that party's over. You are just now beginning to see an increase in auto sales, which is a nice thing, and ironically, probably lower oil prices might do something to stimulate the consumer part of the American economy.
Well, what about the contango moving forward? We could have anywhere between 270 to 800 million barrels of, vessel storage.
Yep.
What's Rick Rule's opinion on the contango?
Again, a function of demand. If you actually get an economic recovery somewhere in the world, besides Rwanda or some market that doesn't matter, that oil can go to energy heaven in a nanosecond. Remember that we use 90 million barrels a day. If there is a 2 or 3 million barrel plurality of demand over supply, the market's priced on the margin. It isn't set across 90 or 95 million barrels. It's set on the marginal million barrels or 1.5 million barrel difference between supply and demand. Supply is going to be less and less of an issue, particularly in North America, going forward. But demand is still a problem. You know, and I know, that full cycle in North America, pick a play, $40 doesn't work in the longer term. There are plenty of companies that say it works, but they're either lying to us or they're lying to themselves.
So at what point do the majors come in to scoop up these assets to increase their RLIs, the reserve life indexes, at a major discount? So when does that start happening?
I think you'll see that begin to happen sooner rather than later. I would suspect that you'll begin to see company and acreage acquisitions in the second quarter of 2015. The major oil companies are much less concerned than I am about the near-term income statements and completely unconcerned about other people's energy price forecasts. They have their own energy price forecasts. So
And their own hedgers' books.
I think, and not just the majors, I think you'll see reasonably well-capitalized independents with good hedge books like Devon and Apache come down into the space, and come down into the space pretty hard. Their concerns are different than yours or mine.
So what about the international E&P space? Some of these...
I'm going to get active in the international E&Ps. If you don't have to worry too much about proved developed producing because you don't have any P, the expectation of success in the oil business is so low now. We're looking right now at providing some capital to an exploration junior that a year and a half ago had a $2 billion market cap. It has a $25 million market cap now. There has been nothing that's happened technically to make their exploration projects less attractive. The outcome, if we fund them, is a binary outcome, and the probability of success relative to failure hasn't changed a bit. The size of the prize, of course, in the context of $50 oil has changed, but it hasn't changed enough to warrant a drop from a $2 billion market cap to a $25 million market cap. The $2 billion market cap was excessive, and the $25 million market cap is probably unnecessarily pessimistic.
And no one else wants the financing, so you get your terms.
Correct.
Now, what about the reality coming into countries like, let's say, Kenya, where at $100 oil they decided to change their PSC system? Now the realities are kicking in. They're going to now become investor friendly again because exploration will halt at these prices.
That's a very important point, Marin, and I'm delighted that you've come to that understanding this earlier in your career, because it will serve you well. What you learn about political risk, if you're agnostic about it and non-racist, is that the politician that's the closest to you is the most dangerous. People tend to fear risks that they don't understand. And resource investors here in Vancouver, as an example, seem to not understand the fact that money stolen from you in English, according to the rule of law, by white people is just as gone as maybe less polite thieves in Africa. I remember 10 years ago or something, when the natural gas prices were very strong, and the Alberta legislature doubled the royalty for natural gas, having extracted $4 or $5 billion in rents from the industry, upfront rents predicated on one fiscal regime. How is what Alberta did any different than what Kenya did? The difference is, of course, complexion. And so you made a very good point. And the second point, which I think you hit on very well with the question, is that countries that can't get worse often don't. Countries that can't get better don't. And so the truth is that the politicians will always steal as much as they think they can get away with. Kenya is coming to the conclusion that they can't get away with anything. And the consequence of that is that you will find that Kenya will be gentler than places like Alberta and Texas that have alternatives.
And bigger deposits.
Correct.
So at what point, Rick, you were with us in the early days of Africa Oil, looking at the transition. I use that as an example of a multi-billion-dollar stock that now has become unloved. At what point does Rick start salivating?
When the Lundin family needs to raise some money. I don't have any particular need to own the stock. I must admit I still own some. Should I have sold it? Of course. But I took so much money off the table that it
didn't matter.
Yeah, it didn't matter. But at some point in time, the Lundin family will need to raise some money there. And Lucas Lundin is a very pragmatic businessman. Lucas Lundin doesn't worry so much about the cost of capital as the cost of not having capital. And to the extent that Lucas has to, in order to raise money from sophisticated investors who have been with him, like me, for 4 decades.
And with his father before that.
And with his father before that. He understands the efficacy of a warrant. And he understands the efficacy of a 5-year warrant. He understands that if you put up the money to save a project or to move a project forward, that you want some reward.
And now the exchanges can do 7-year warrants.
I
and
saw
listed
that.
and tradable.
Wasn't that wonderful?
You and I are going to do the first 10-year warrant. That's my mission.
Wasn't that wonderful? Well,
let's go to someone like Lucas, who I call him kind of like the Star Trek. He'll go where no man will go. He's going into Ecuador hard. At what point does Rick Rule say, well, I'm going to watch and see, rather than jumping in alongside the gorillas in the business?
I'm right there with them. If you accept that to make $1 billion as a speculator, most of your decisions are bad. What you learn is that political risk, while it scares people, is always less extreme than technical risk. The normal reason for failure is that you generate no wealth for the politician to steal. And when I think back where I have been with the Lundin family, in the early 90s, of course, in Russia, 3 times, all tough, all happy endings. In Congo, in Sudan, where else have I been with them? Oman. Kurdistan. I mean, pick a hard place. I've been there with them, and I'm not trying to suggest that it's worked out in every case, but it's being in bad places with good people has made me way more money than being in good places with bad people.
But at the same time, always at the same price as them.
Yes. And the Lundins, The Lundins understand being partners with aggressive long-term investors. It's one thing that you will note in your career, because you'll be able to do business with the third generation of Lundin, is that at market bottoms, first of all, they'll write their own checks, and secondly, that they will allow you to write checks at terms that are appropriately priced in the market. I remember Adolf Lundin telling me in a very bad market, the idea that I have to accept 35% dilution is painful, but my ability to employ that money for a 500% gain makes the mathematics compelling. And it's that type of realization that separates an Adolf Lundin and a Lucas Lundin and a Robert Friedland and a Ross Beatty from the Flotsam and Jetsam. One thing that really amuses me, Marin, and I hope you use this in your discussions, when the C-grade promoters in town say that they want to give you an 18-month half warrant, you need to say to them, you must be a financial superstar, because Robert Friedland just issued a 5-year warrant. If you're enough better than Robert Friedland that he has to give up a 5-year warrant, you can get an 18-month half warrant. There must be something about your track record that you could show me.
So in this market where we're getting a guy like Ross Beatty at a discount, you're getting Lucas, Robert Friedland, perfect example, $4.50 IPO to 80 cents today.
Yep.
Now, you're looking at the private placements, but that's also trailing where the commodities have gone. Where do you see copper?
Same as oil. I don't see any demand. I see the copper price being soft for 2 or 3 years.
So are you trying to find someone like Ross again, or backing Ross to do Lumina again, which essentially spit out 64 times your money in 7 years, 8 years?
If I could find a Ross Beatty, I would do that again. The hoarding strategy has been enormously successful for me. It's difficult in junior markets to get somebody to do the hoarding strategy correctly. You have to negotiate tenaciously. You have to buy good projects, knowing that they make no money in this market. But then you have to do 2 things that are very difficult. You have to do nothing. And doing nothing is very hard for a management team. And the management team has to be willing to be paid appropriately for doing nothing, which is to say not much, because holding 5 or 6 copper assets for 6 years, in holding them, the G&A that you lose over 5 or 6 years adds to the price per pound that you pay for the copper.
But more importantly in this market, exchange listing fees, accounting fees, lawyer fees, director fees.
Correct.
Rent in Vancouver.
Right.
You're looking at minimum to run a public company without salaries, without G&A, you're looking at $400,000 or $500,000 a year. At what point is the model broken, Rick?
Well, I think that's a good question. We just tried to buy a package of assets here in Vancouver. We ended up being outbid. We thought we were the only bidder, and that turned out not to be true. And we intended to do that personally, privately. There was a syndicate that had $15 million put up, and the idea was that we wouldn't burden ourselves with financial public relations and listing fees and all that kind of thing, that we would do privately what we did publicly years ago with Silver Standard and Pan American and Lumina and Vista, the whole legacy of those wonderful optionality companies that we put together. But your point is very well taken. Unless you really have scale, unless you've acquired $30 or $40 million worth of assets, the drag associated with public company expenses makes it an unrealistic mechanism. I lean towards public companies for 2 reasons. I have an obligation to 200,000 investors who are clients of Sprott and are looking for investment opportunities, most of whom cannot accompany me on $15 million private ventures, where there's $1 million minimum ticket. The second thing is that being dressed in public clothing gives you access to quick, cheap capital, assuming that market conditions change. And in terms of subsequent financings, it limits the discussion as to pricing, because the pricing in some way, shape, or form is established by the market. So there are advantages to financing these things in the context of public markets. But the disadvantage that you cite is a critical one.
So let's take the psychology of this thing, because I think as smart as you are technically and your team at Sprott, I think a lot of it comes down to the street sense and the golden glove boxer of Rick Rule. And I'm willing to bet that 90 to to 95% of your net worth has come within less than 5% of your investments. So what is Rick Rule's rules to portfolio management? Will you max out at 10% of your fund's money in any one deal, or 5%? Do you have rules like that? How do you manage your portfolio, Rick?
I don't. I subscribe to Warren Buffett's maxim that the ideal investment would consume 100% of one's portfolio. I've never found one of those. And that the ideal holding period is forever.
But in the resource cyclical market.
Yeah, the truth is that mostly what you discover is that, as an example, if I have a partnership with $50 million in it, normally the most I'm willing to allocate to any one shot is $5 to $7 million, because my realization is that the probability is that the decision will be a failure. Now, you and I both understand that the ebbs and flows of people's emotion in a public market is such that you can usually trade out of a losing position with a 20 or 30% loss. You don't need to turn it into a 100% loss. But the truth is still that if, as an example, in the course of a 10-year partnership, I've made 120 investments, probably 6 or 7 of them give me all of the success that I enjoy for the entire partnership.
How do we handle the liquidity, though, Rick? The liquidity today is a much bigger challenge than at any point in the last decade.
We use it. It is the very fact that there isn't liquidity that gives you and I, who have gated funds with sophisticated investors, the opportunity to compete. In a very good market, the generalist players who just care about liquidity and don't have an understanding of the value proposition offered up in the sector will always outcompete us. If you and I compete against dumb money, which is what you do in a bull market, you become dumber money. You consign yourself to failure. It's only in a period like this where there is no liquidity, and as a consequence of the fact that there is no liquidity, there is no competition. It's only in a market like this that you can put together a portfolio where you have the chance, as I've managed to do with a couple prior portfolios, to generate 20-fold return in 5 or 6 years. Mark my words on this. 5 years from now, 6 years from now, something like that, when you're about to be baby, is 5 years old or 6 years old, you will look back and you will say 2015 was the good old days. It was the good old days.
But Rick, your psychology, we've invested together privately and publicly, we've done well, but let's go back to the psychology of knowing when to back up the truck. Mm-hmm. Your Paladin example, I think, is the best example of you made your bet, you did everything right, unloved sector, and then you still lost 90% and then backed up the truck again. Yep. How do you know when to back up the truck and not?
I think it's important.
Maybe explain it to the viewers who don't know the story. Sure.
The story goes back to 97 or 98. And the uranium sector at that point in time had been in a bear market since 1982, since 3 Mile Island. So a really extended bear market, almost a 20-year bear market. Not only did people not have any economic expectation for uranium, they hated it. If you mentioned uranium in the context of investment, people thought about Hiroshima and Nagasaki and 3 Mile Island. So they weren't only bored, they despised you for thinking about it. And that to me was sort of the ultimate contrarian opportunity. Meanwhile, on a global basis, if my memory serves me well, we were burning 150, 160 million pounds a year of the stuff, and we were producing 70 or 80. It cost the industry about 20 bucks a pound to make the stuff. They were selling it for 10. Losing 50% on every pound they made and being dumb miners trying to make it up on volume. It was an ideal setup. So I went around looking for ways to participate in uranium, and there were almost none. I, however, had the good fortune to come across a wonderful man, still a friend of mine, named John Borshoff, who had the same vision as I, and he had a little Australian uranium explorer, and he'd been buying uranium databases through the whole bear market. And so I backed him. I bought some stock at 10 cents with my dear friend Doug Casey. We did a financing for him with a nice fat warrant because he had no other alternative. The stock traded up, I found out in retrospect, mostly because I liked it, and there wasn't much float. It went up to 15 cents or something. We financed it again at 12.5 cents. And then began this ugly slide. 12.5, 11, 10, 9, 8, 7, 6. The stock chart resembled a topographic map of Grouse Mountain, the ski hill. And somewhere around 2 cents, in addition to the fact that we were off by 80%, the company was running out of money. And we had to re-examine our precept. We had to think through, were we right and early, or were we wrong? And we undertook a fairly thorough re-examination of the reasons why we had bought the stock and the management's performance. And we decided that we were in fact right and the market was in fact wrong. And we gulped 4 or 5 times and wrote a check. If my memory serves me well, it was a 1.5 cent check, which is a very difficult thing to do if you're off by 90%.
How many people bailed on you that supported your first thesis?
Everybody. Everybody.
And during that time frame, what was the time frame?
A couple of years. A couple of years, from 12 cents to 1.5 cents. The great news, of course, is that the third investment was a very well-timed investment. The uranium business picked up, and within 3 or 4 years, that was a $10 stock. Now, I wouldn't lie to you and say I held all of my 1.5 cent stock or 10 cent stock to $10. That's not, as you know, my want.
But that's the beauty of warrants.
Yes, it is the beauty of warrants. That's exactly right, exactly right. And so I think it's important every step of the way. I think it's important when you make an investment that you understand why you're making the investment. You're making it because the capital that you contribute is going to cause X, Y, and Z to occur, or you hope it's going to cause it to occur. And if there's some variance, if there's something in the results that tells you that the probability of a yes answer is declining, your position has to decline too. Too many people don't understand why they own a stock. And when the reason to own the stock goes away, they forget that the stock has to go away. Somebody says, I bought the stock for $1 and the stock is now at 65 cents. I'm going to wait for it to get back to $1. Well, why would it get back to $1 when the unanswered question came back no?
But Rick, when we get into the investing style, you have a closed-end fund, I have a closed-end fund, and both of us have bought out investors who've lost passion of the patient factor. I personally think the most insane thing an investor can do is invest in an open-ended fund where other impatient investors can have redemptions and sell good and bad stocks, cause that pressure. What's your take on that?
Well, certainly in volatile sectors, open-end funds are risky for investors. The truth is that for many investors, the only opportunity that they have is open-ended funds.
But why is that?
Because they can't afford the $100,000 minimums or the $200,000 minimums in your product and my product. There are a vast number of people who would like to speculate in the sector with professional leadership that have the ability to invest $5,000. And there are products which are suitable for them. There are products that are, over time, less likely to be as successful as our products. But the truth is that there's a place for those products, provided that the people who operate those products, the managers, understand what they're dealing with, always maintain enough liquidity, always maintain an eye on the market for redemptions. The difficulty, of course, that the open-end fund manager has is that money leaves the fund precisely when he or she should be investing, and money flows into the fund precisely when he or she should be selling. I mean, I think one of the best investment managers on the planet is Frank Holmes as a consequence of that. The ability that he has had over time to manage the ebbs and flows into his funds, where he has no closed-end products, has been astonishing. I'm delighted that I'm not in Frank's shoes and that the funds that I manage are of a different type. One of the things that you're starting to see in the fund business, which I think is intelligent, is the emergence of the exchange-traded rules-based funds that are certainly in an upper strata of the market, but the idea that an open-ended fund can consistently outperform the market when a coalition of open-ended funds are the market is statistically improbable. And if you do rules-based investing rather than stock picking, confine yourself to liquidity and cut the fees, that's sort of a direction that Sprott's going. We see that as a user-friendly substitute for the traditional open-ended fund in a volatile sector.
Now, you've been around during the 60s, the 70s, the 80s, the 90s, the good, the bad, and the ugly. And you've seen the characters that attract the inflow of money, whether it's Jim Dines, Doug Casey, all these different characters and newsletter writers. And what I've learned listening to and meeting subscribers to these, they're attracted to the stories, more so the characters that bring them into this business. And unfortunately, they don't have the discipline and they end up owning 60, 70, 80 stocks. What's the maximum you own, or on average, how many stocks do you own in your portfolios you manage in yourself personally? Number two, what type of warnings do you have to give the person who comes into this sector going, geez, copper's down, oil's down, might be time to invest. Doug Casey seems interesting. How do I invest?
That's a fantastic question. And I tell my private clients, for whom we act as brokers, invest in the number of stocks that you are willing to spend an hour a month on each of them. So if you're willing to spend 10 hours a month, you can own 10 stocks. If you're willing to spend 15 hours a month, you personally are willing to spend 15 hours a month, you can own 15 stocks. The limiting factor is, first of all, use money that you can afford to lose half of in speculation. So that's the amount of money. And the number of stocks is the amount of money that you will spend 1 hour per month checking up on.
So how much do you own and how many stock
I have a
positions do you?
huge advantage because I have access to an organization with 170 employees, geologists, geophysicists, analysts, and things like that. In portfolios that I have direct control of, I suspect that we have 60 names.
16 or
60, 60. Sprott-wide, I suspect that we own 370, 380 names, which is a number that I would like to cut in half this year.
And what about warnings to investors from, all of the talking heads at these resource conferences and these newsletters? What advice do you give to people? You've seen all sorts of characters.
Common sense. In terms of taking advice from people, just listen. Many people who attend resource conferences gravitate to the simple declarative statement. They don't want a nuanced answer. And the willingness to put out a simple declarative statement, I think, is indicative of the fact that the person probably doesn't know what they're talking about, because the answers to all these big questions are nuanced. When a person goes to a conference looking for guidance, they often confuse confidence with wisdom. There is something neat and tidy about a simple declarative statement, but in my experience, they're usually wrong. So I pay particular attention to somebody who, when I ask him or her a question, thinks about it for a second and says, I don't know. I just don't know. I can help you with this or this, but that particular question is above my pay grade. That tells me that the person that I'm talking to is disciplined and self-honest, and in addition to that is honest to me. The person who seems to be a ranking expert in every topic on the planet, that seems to me to be an implausible goal.
Rick, the biggest risk I see in the business right now, and we've discussed this, we created a fund to be based on this, is you're the younger of the older generation. You're the youngest warrior of the older guard.
Very true.
And the younger guys, my generation, are more interested in ripping around town in the new Ferrari and, the parties at the Super Bowl. And so the question I have for you is, how are you positioning your future? Not just within Sprott, but looking from an investment standpoint, how do you find the next Lucas Lundin or Ross Beatty or,
Well, one of the ways is empowering you to do it for me. But I guess that's cheating. You control first the things that you absolutely can control. And within Sprott, we've done a pretty good job in the last 4 years at finding people, young people, smart people, who should be in the organization and bringing them in, and allowing people who had skill sets that were suitable, more suitable to other organizations, to find places where they would be happier. And we have a very deep and very competent second and third generation. And I would say, in response to some of your suggestions regarding your generation, that at least in the context of Sprott, they're incorrect. I hear from people my age that people your age are undisciplined or undereducated, have poor work ethics. What we're experiencing right now is that the influx of new blood into our business are highly ethical. They got out of school with much more information than I got out of school with. They came into a job market that didn't exist. They work like scalded dogs. Now, we have seen less evidence of that in the issuer community, although certainly you have Mark O'Day, Ira Thomas,
the next 10 list.
Marcel de Groot. I mean, you have some people out there who, yes, have made mistakes, every one of them, just as my generation made mistakes. The difficulty, I guess, is that your generation got force-fed cash, and the mistakes that they made had an extra zero on them compared to the mistakes I made. But the process is still the same. You don't want to back a young person that hasn't been eviscerated once. The truth is that in the decade of the 1970s, I did extraordinarily well. And the consequence of that is that I came to confuse a bull market with brains. And although I didn't do too well in the early part of the decade of the 80s, I set up a spectacular career as a consequence of the scars that I earned in 81 and 82 when a bull market turned into a bear market. And that the process should be any different for the Mark O'Days and the Marcel de Groots of the world doesn't make any particular sense. The fact that these guys have endured enormous shellackings in the last 4 years is unpleasant for the people who backed them then, myself included in one case, but will be of enormous benefit to the people who back them going forward.
Now, would you know, we've been in this bear market for about 4 years now. What's to say it can't go for another 6 to 10 years in the equities, not the commodities, but these equities?
Probably nothing. I have found myself that my own successes haven't correlated particularly well with equity cycles. They've correlated much more closely with discoveries. Large discoveries, as an example, Adolf Lundin's discovery at Ras Al Khaimah happened in 1983 when the oil price collapsed. The truth is that Adolf found so much that the market price of the commodity became less of an issue. Another example would be the gold successes that we had in the context of Arequipa and Francisco. The truth was that exploration paid dividends for us that were non-correlated to the equity cycle. Were I a better trader, which I'm not, I would have the ability also to trade the equity cycle better than I do. My own particular discipline really involves the realization that I'll be wrong more often than right, and the tolerance for incremental failure on the way to absolute success. And it's much less tied, I think, to the equity cycle, except that in periods of poor equity pricing like today, I have better access to product with less competition.
And Rick, how can someone invest in you?
What I would advise,
not be handed off to someone who's not Rick Rule, but in Rick Rule.
What I would advise first is for people to determine that they'd like to invest with me. And in that regard, I'd love it if people would visit our website, www.sprottglobal.com, look on information, and subscribe to Sprott's Thoughts, where 3 times a week you get the best information from within the Sprott organization and from without the Sprott organization. We'd like, as I told you last week, to interview you about your new book. I guarantee that your listeners will get their money's worth because this is absolutely free. If you go through this process and like what we do, there are a variety of opportunities to invest alongside myself, the easiest of which is simply to buy stock in my employer, Sprott Inc., where I'm the second largest shareholder. It's a way that you participate in everything I do, and rather than pay me a fee, you get to collect a dividend.
Rick, thank you very much.
Pleasure, Marin. Thank you.